Good morning, everybody. This is Scott Broomfield. I am the Managing Director of the Epic Fund, ESG Focused Investing. I am also the chairperson of Integrate 21, the conference for CFOs to learn how to adopt and execute and operationalize ESG factors into decision making and investing that helps create a regenerative finance function. We do these podcasts fairly regularly and bring in interesting folks. Today, I am pleased to introduce Jake Walko. Jake is the Director of ESG Investing and Global Investment Stewardship at Thornburg Investment Management. Jake, welcome.
Thank you, Scott, and thank you for that kind introduction. Just a little bit about myself, just so everyone on the line can believe me a little bit when I when I dispense advice to CFOs. I've spent about the last decade plus, specifically in ESG, mostly on ESG investing teams at BlackRock, Neuberger Berman, and now here at Thornburg. My remit here as Director of ESG Investing and Global Investment Stewardship mostly focuses on two things. One, ESG integration, meaning the proliferation of ESG thinking and analysis and process in the investment decision making across our product suite. But secondly, and I think actually in many ways equally importantly, an alignment with clients, meaning that there has been a long historical focus on financial outcomes, which prevails to this day, but we are sometimes remiss in forgetting that it's all about knowing your client, knowing what their preferences are and what their focus areas are. And obviously in this world that we're living in, that is increasingly mindfulness towards sustainability and many focus areas like that. So that's just a little bit about me.
Well, Jake, thank you very much for joining us today. When we were prepping for the call, I was impressed with your staff. Could you give us just a couple of sentences on your staff and,
Sure.
and kind of what you focus on?
Sure. So we're a private manager. We're based in Santa Fe, New Mexico, out of all places. So not your usual New York, London, Hong Kong type of a shop. And just for your information, we manage just shy of $50 billion in public markets investments. We're a 53-person investment team, and I report to the co-heads of investment, which I think is actually a very important dimension of ESG and quite a change from I think what you might have seen 5 or 10 years ago, where these were sort of thematic, very niche, small functions, right? Now it's about getting everyone on board. Everyone here on the investment team is responsible for ESG research, even if they are managing products that are not ESG labeled. So this is about collaboration. This is about supporting one another. This isn't about sort of sending one guy into the ether to do something on sustainable investing.
That's actually a great, Jake, a great segue. For many years, the word sustainability seemed to be the operative word. The SDGs came out, starting from the Millennium Goals, and now the acronym that we use is ESG for Environmental, Social, and Governance. And oftentimes it was the role of the Chief Sustainability Officer that took the lead there. We have a particular belief at the Integrate Conference that we want to accelerate capital flows, and we believe that needs to be central to what the finance function does. So would you please sort of give us your sense of the role of finance as it relates to ESG stewardship and investing, and specifically how to think about decision systems as it relates to the role of the finance function within the organization?
Yeah, so I think that this is a very complicated conversation, right? And so I'm going to start by framing it just on the basic level of what is investing in asset management in this sense of ESG, right? And that is very much about being selfless by being selfish, right? And so what I mean by that is you increasingly see evidence right now, I think in many ways settled evidence about the value of incorporating various ESG factors into the investment process. And by the way, just, these words, ESG, sustainable investing, responsible investing, there's so many of them. They're interconnected. They're not exactly the same, but I think there's probably some need to have less confusing terminology one day in the future in the industry. But these factors are important. They support good research. They support good investment decision making. And so if you are an investor, you can have good performance. And as a consequence of the performance that you are receiving and the risk management that your portfolios have, you can also support businesses that, quite frankly, just in essence, what they're looking for is providing solutions to future demand, right? So the future demand is solutions to climate change. A business can make a lot of money providing the widget for that, right? If the future demand is helping support healthy societies that are not, income, unequal, then a company that provides services that are such will be successful, right? So it's all about being placed correctly, right? And so the consequence is that your investment supports, the lower cost of capital that those businesses then realize, the support in broader capital markets that they enjoy, right? That essentially enables them to become continuously those innovative providers of solutions. The way that financing is specifically important to this is obviously, yes, capital markets, but also organizationally about how different players in the organization provide the budgets and the resources to make these things possible, right? So I know it varies across organizations, CFOs, COOs, CEOs, right? Different people have different roles across different businesses. But what's important is to be able to understand that succinctly you're all driving for the same goal, right? And we can dig into some of the details of that.
So the CFO plays the leadership role.
Yeah, it's always a good question, right? So in some organizations, it's a little bit of a budget setting exercise, right? And in other organizations, it is vision and leadership. In others, it's about listening, right? And allocating and approving resources to the appropriate places. I think that the big challenge here, right, is that when you're an executive, you are listening to many different people, and those people represent their own sort of unique silos, right? And obviously, I'm not going to revisit the point about silos having a negative connotation in all industries, but the reality is that that's how organizations work, right? Because you have to make decisions in some way, right? And so when you think about what does that mean? It means that an individual department is never going to come to you, even if they have sustainability goals as part of their day-to-day operations. They're never going to elevate that to be the top priority, right? But they still need budget and support for it. That budget and support might be very similar to what another department needs, but it's articulated differently and it's asked for differently, right? So the leadership component of what the CFO's job is understanding what are these different things being asked for and how are they similar, and which departments need to work together on these things, and how individual departments need to be supported, right? So if you think about, I'm just going to sort of pick on a particular department. If you think about a compliance department is not going to be driving your sustainable vision, right? It's not producing the widget. It's not dealing with clients, right? It's not sort of looking out for what new markets the company needs to be in 5 years. It nevertheless supports every single department in its review of sustainability goals, whether it's through marketing materials or, interactions with clients and so on and so forth. So that department, even though they may not, put it on their top 5 agenda item when asking for resources, nevertheless is crucial to the success of those other departments.
When with CFOs that are going to be listening to this podcast, they come from various industries. And so we won't get into the specifics of best practices for each industry here. But what are a couple or a few of the things that you have seen that CFOs do that fully incorporate ESG factors into the decision process? What kinds of things do they look at? And it would be helpful, given the breadth of your background and what you do at Thornburg, to sort of generalize that, because that's
Mhm.
where you can get some context across a wide group of different kinds of CFOs.
Yeah, and so what I usually see is basically I'll be on a call with a management team, and depending on the company, it will be different people, right? So maybe they start with the general counsel because they think that these are questions about risk management, but then they end up with the CFO on the call because it is more about future direction and so on. So it varies across organizations, but my general view on this is a couple of pieces of advice, and these are gonna maybe sound a little crude at first, but let me sort of elaborate a little bit. The first one is just to set a goal to start somewhere. And I know that CFOs are going to be most the people that are not going to like the idea of setting a goal that doesn't necessarily have an end, right? But the important part of this is an exercise. So if you set a goal, let's say you set a goal about reducing emissions, right? Or about aligning with clients or surveying clients, right? It's not about getting it right the first time. It's about getting the feedback from the people who have to action the goal, right? So what you're paying for essentially in the beginning with that goal and that effort and those hours that everyone is spending on it is to understand how your organization is going to be able to cope and have advantages in, and then have risks and challenges in meeting a goal like that, right? That way you can understand, okay, maybe this particular department, I thought that they were strong in this area, but they're actually, they're actually in need of support. Maybe these other guys are going to be your wild card and are actually stepping up. And maybe, as a consequence and a tangent, you realize that there's people who are talented in that area who can take on more, right? So it's all about setting a goal and starting somewhere, right? The second thing is about when you set that goal, asking each department how what they're doing and how the budgets that they're requesting is supporting that goal, right? So that you sort of get them thinking about it, right? And maybe again, in year one, there's no good answers, or the answers are kind of, mediocre, but it's all about challenging them to be creative and innovative. The third one is having real conversations, right? So this is already part of the process, right? Accountability is the name of the game here, but this is about, going to someone who's leading a workforce and saying, what does success in this goal that's organizational look like for your department, right? Does it mean that your staff need to be better educated? Does it mean that maybe, maybe they're stuck on a floor of the office building or in a remote location where they don't interact with another department? They actually have to start interacting with quite a bit, right? That's been something that I've observed has been a challenge in my career, where all of a sudden I had to dig out, a person from a different department who's never interacted with my team, and all of a sudden, ESG is becoming their life, right? And so, that's not ideal, right? Because you don't want people in the organization to have to, come up that learning curve when you're in a crunch on a project that's important to the success of your company, right? So I understand that much is made about collaboration, right? But let's be honest about how much people in an organization interact with one another, right? And then the last one, I think, and this is an obvious one but an important one, is look, no one's when you have emergent issues, and ESG and sustainable investing, I think, is still an emergent issue in some ways in many organizations. No one likes to go to bat and take a risk on making the case for something that may not pan out, right? So you have to sort of step aside from making decisions by consensus and majority voting and so on, and make sure that some credence is given to those voices that maybe have the courage to step up and say, maybe this is going to become important, maybe this is something that we need to start exploring, and support them as if that's the that may be the sort of the lottery ticket that will make your organization successful in the future.
Let's take us down one little path for a moment on time dimension. Companies do annual budget cycles, they do quarterly business reviews, they do budget versus actual analyses. How does this idea of ESG and a regenerative finance function incorporate the time frames of decision making? Because oftentimes these things don't happen in quarterly or even annual increments. They take time to develop. Can you comment on that for us, please?
Yeah, so I think it's important to just accept from the get-go that these are not going to be revenue generating ventures on day one, right? Um, this is about things that are just very difficult to do attribution analysis on and get a real ROI sense on, right? And the simple reason is because it's, I know that we again live in this time of big data and having information on everyone and everything, right? But I think that in some ways people have sort of gotten ahead of ourselves in terms of just how much information we really have, right? The reality is that we know little about our clients because we survey them on things that are very general. They're traits and characteristics that are sort of high level, right? But we know little about how people make choices and what their true preferences are, and maybe what their sixth preference is on that doesn't make it into the survey. And so that's a long way of saying that you have to invest for what you think the business needs to be, not only into things that are immediately creating returns or that are immediately saving costs, right? Yes, there's going to be significant opportunities for that, right? Resource use efficiency or efficiency in your operation sort of make the case for themselves. But I think that you could be an anti-ESG CFO and understand that, yeah, maybe if you turn off the lights at night, your bill is going to be a little lower, right? And I'll take that. I'll take that. I don't need you. I don't need you to be, perfectly labeled as, a future leader to just, save your company money by and as a consequence make the world a slightly better place. What I think is the really the bottom line on this is this is an investment, right? This is an investment into the capability of your organization to meet future challenges, right? And just so happens that this is about sustainability today, but it could be really any challenge. It could be being in a new market, right? So I think looking past the cost and looking past the time horizon, and into the future, and really thinking about how can I as an executive maybe put the seeds in the ground today to make the work of the future people that are going to be stewards of my company that much easier, right? So that the company isn't spending 100x of what we could have spent today to, manage a problem that was easily avoided by just prudent, foresight now.
You had started the conversation with saying that Thornburg has 50 billion under management in public companies. To what degree is the evidence strong or weak, for that matter, that companies that focus in this arena perform better over time, that factor ESG into their investment decisions?
Yeah, so I've got a kind of an academic answer for you, and then a very brutal, candid answer that I think the listeners may appreciate. The academic one is look, if you survey the literature at this point, better ESG companies outperform the market, have lower cost of capital, lower employee turnover, more stable earnings, fewer bankruptcies, right? The list goes on and on. What I think is important for people to understand is that a lot of that evidence has come very recently, right? So this is something that has really gathered critical mass. So if you're a skeptic, which I hope that everyone is a skeptic, I would just invite you to revisit what the latest work on this is, right? Because it's really come out strongly in favor of different types of ESG, right? So it's whatever suits your company. It could be that you're outperforming because you have great risk management. It could be that you're outperforming because you're in the right markets. It depends a little bit, but the literature is abundant. The candid sort of perspective on this, and this is really targeted at CFOs of public companies, is that if you aren't hearing about ESG, it's because you are not receiving investment from companies that are looking for ESG. It means that my ESG fund doesn't invest in you. So you've already missed out on that capital, right? It means that an asset manager that is really focused on this, and look, ESG flows have been through the roof for the last couple of years. It simply means that if we're not asking, it's that we've already determined that you're not eligible, right? And for us, we're running concentrated portfolios. We're not interested in someone that is, bottom quartile in something. We might be if you show us that you are looking to make dramatic change and see re-rating and become successful in the near future. But we're mostly looking at successful companies because we only have so many dollars to allocate, right? So I always think that's a little difficult for executives to hear, but I think that's the reality. Who are your shareholders? Who's really invested in your fund? How much of that capital was actively making choices to invest in you versus sort of, cruising towards some, kind of middle of the road return, and equally so will abandon you the next time the company starts struggling.
No, fully understand. One final question. There was one thing that a CFO could do that they might not be doing. Just one thing that would maybe move the needle a little bit. What would that be?
So to me, it's about being an investor. So often, I understand that a CFO has a tricky and difficult job, right? You're very focused on specific metrics. You have to deliver on, or at least explain, performance in those metrics on a very, quarterly basis, right? Short-term basis. I think that it behooves CFOs to, roll up their sleeves a little bit more and get to know the kind of the bottoms of the silos that they're supervising and whose performance and metrics they're supervising, and really try to understand what are the cross-cutting issues across those departments. Because often I think some of the challenges are universal, and I don't mean for this to be a silly example, but even what systems does the firm use and what is the connectivity among employees? Maybe making a small change, will enable everyone to be 5% more successful at their job, and that translates to the top line metric that you're focused on, right? I'll offer a kind of another silly example. Sometimes organizations try to limit the size of Outlook inboxes to save some money on IT systems. If it works, it works, but I don't know that that's that's something that impacts everyone, and I don't know that it's always the sort of the best decision for all of the employees and their effectiveness in the organization. So it's a silly example, yes, but it's a demonstration of the fact that those are really small things in the day-to-day of the people in your organization that are ultimately going to need to work together to make that top line number successful, right? That top line number look good, right? So being a little less focused on revenues and EBITDA and so on, being a little bit more focused on how can we all, what are the needs within the organization to be successful across departments. And I know that's obvious, but I think that it's worth repeating.
Jake, I want to thank you for your time today. It's been a pleasure. I'm looking forward to seeing you face to face coming up here in November on the 8th, 9th, and 10th at Fordham University, the Gabelli School of Business. That's where the Integrate Conference is going to be. I wanted to also just personally say thank you for being part of the Integrate Working Group and helping us think through the agenda for the conference, and basically how do you create a regenerative finance function, and how do you factor this stuff in so that we can actually create a regenerative present and be less extractive in our world. So thank you for your time. For those of you that have been watching and listening, Jake Walko from Thornburg Investment Management. I'm Scott Broomfield, the chairperson of the Integrate 21 conference. If you would like to learn more, go to integrateconference21.com and you will see that. And we look forward to seeing everybody here in November. Jake, thanks very much for your time.
Thank you for having me.